Welcome to Cheques and Balances. I'm Michael Vincent. This is James Blair. And this week we're joined by Matthew Harris, Director of Lighthouse Accounting, to talk about what to do if you're priced out of property.
Matt, great to have you again. Managing Director of Lighthouse Financial Services, Property Advisor to the Stars, and Mr. Taxman. How are you?
I'm good, thanks, James. King of Property has returned to talk about something shockingly property related.
So Mike, this was a good idea that you came up with around. It's just getting harder, right, around the property market, and the question is, what do you do if you can't do property?
Yeah, and there's a lot of sort of changes that have come into the market recently. Reserve Bank tightening the low deposit loans, banks tightening up their credit policy, which is just making it a little bit harder to borrow money. And of course, as always, we've got house prices that just continue to track higher and higher and higher. So the natural fallout of that is some people are going to be priced out of property.
Yeah, 100%. And in the old days, which was only a few years ago, if you came into our office and you had $100,000, you had no other investments, nearly always the very first thing we would do is try and get you on the property ladder. And that's because we can use leverage, the rate of return is exponentially higher for you, gets you on your journey, and then as you mature through that journey, you would invariably end up in some sort of superannuation and probably investments of some other type. But now, that is not necessarily an option. $100,000 isn't going to get you very far in New Zealand with relation to a property. So, James, tell us, what do we do now for those clients?
Yeah, I think the answer is it depends on a few different variables. The first one is sitting on your hands is dangerous, and there's risk with whatever you do in life. If you do something where it's a higher risk activity, where it's like an aggressive portfolio, investing directly into one share, buying a property where you might be in trouble if interest rates go up. There's a risk with all those things. There's also risk leaving money in the bank because of inflation. So essentially, your money is going backwards, maybe 2-3% per annum. But at the moment, with supply chain issues, us coming out of COVID, hopefully at some point in the future, there's the risk of your money going backwards even further.
Yeah, and I think the inflation point is a really key thing for this. And the traditional thing has been term deposits, right? Well, I'll just put it in a term deposit. I'll get some interest. It'll all be fine. We've talked about this on the podcast before, but if you put it in a term deposit, you're almost guaranteed that your money is going back every year. So I'm going to make the assumption here, James, and I could be wrong, but you're not going to tell people to do term deposits?
Once again, it depends on what you're trying to
get off the fence, James.
Work towards in your goal. So let's say, and this is a super common thing that I'm sure you both see all the time, right? I've got $100,000. I can't do the property now, but I still want to do property. Yep. So I'm going to invest into a crypto portfolio or a share portfolio for 6 months, make some returns, and then pull out. Yep. If that is your attitude, wrong. You can't be investing into assets like that for such short periods of time. You need to make sure that if you're investing into like a conservative managed fund, that you're investing for at least 3 years, more aggressive portfolios, probably minimum 5 to 7. So if the outcome you still want is property as soon as you possibly can, that's why I say it depends. You need to think, well, if I still want to do this in, say, a year's time, you're going to have to stay in cash, but you've also got to acknowledge the risk of what you're taking.
Yep.
Now, if you've, say, got an owner occupied already, say you're already on the property ladder, but you can't go again, we'll use this example first. The most logical thing to do is to continue to pay down your mortgage because you're naturally growing your equity because you're reducing your debt, puts you in a position where there's still more options for you in the future. If you are a first home buyer, or want to be a first home buyer and you've got cash, it just becomes more tricky because if you invest into those assets I mentioned with a 1 to 2 year time period, you just shouldn't do it. And the reason for that is you're going to end up with less money than what you put in. If you said, hey, I'm quite comfortable renting, I understand that even if things loosen up or plateau, I'm not going to go straight into property. That's where you can look at things most likely being a managed fund or a share portfolio, the lowest hanging fruit, making sure you've got good diversification in terms of the your asset classes. So you can also invest into like commercial property funds, some exposure to bonds and cash, international shares, Australasian shares, diversification around industries, so
Yep.
you're not dependent on one particular industry doing really well, and diversification around countries, because some countries perform better in certain years.
Yeah, I think, and do we want to just quickly jump in? We've used the word inflation a couple of times already. Inflation at the moment in relation to property is obviously the increasing prices that property costs and everything in that supply chain. But more importantly, when we're talking about those people that have that $100,000 deposit or whatever it is, inflation erodes the value of your purchasing power, and so it erodes the real value of that dollar. And that's really the risk of not doing anything. Your money's getting worth less and less, whilst everything else is getting worth more and more.
Yeah. Risk with everything you do. I mean, it sounds depressing that that's the way the world works. There's opportunity costs of doing something over something else, opportunity cost of doing nothing. And coming back to that, what if I'm priced out of the property market? The first question is, well, how long are you going to be priced out of the property market?
Yep.
And can you get your head around being comfortable investing into a diversified portfolio? Would probably be I'm sorry, Mr. Crypto, I'm not going to talk about chucking money into crypto.
I knew you weren't going to recommend it.
Yeah. But hey, if that's what floats your boat and you understand the risks and you believe in it thoroughly, then obviously that's an option for your capital as well.
Yeah, and I think what you said about you can't just jump in for 6 months. You can't actually do that with any asset class. It's just that obviously something like crypto and or share investment's pretty easy to jump in and out of.
Yep.
But you can't short-term invest.
Yeah. And so I know we're talking about priced out of property, but fundamentally, I'm a mortgage broker, so I'm going to quickly run through a strategy maybe that might be able to get you into property a little bit quicker, and that is partnering up with someone to purchase a property. Now, usually I advise against this unless people have to, because it always gets more complex down the line. What happens if someone wants to sell? What happens if someone doesn't want to sell? What happens if someone loses their job and can't pay? And all of these sorts of things, right? But if this is, if you're thinking, no, I need to do this now. I've got someone who I've known for a long time. I trust. Maybe you're flatting together already. There are banks that have really good credit policy that can sort of match this. If I look at Westpac, for example, their credit policy states that if you guys are living together and you're sharing reasonably some finances, so maybe you have a shared bank account for bills or something like that, they will treat you as one household. Now, that is a really important thing when you're applying for a mortgage, because it means instead of 2 households worth of costs, you have 1 household's worth of costs. And that can be really powerful in terms of how much you can borrow and your ability to get on the ladder a little bit quicker. So what you've got there is 1 household's worth of costs, 2 separate deposits, 2 separate incomes coming in, and that might just be a strategy to get you on the ladder a little bit quicker.
So in summary, what to do if you price out property? Buy property.
Exactly. From the mortgage broker.
Yeah. And proportional ownership schemes is an option.
Yeah, definitely.
And they've traditionally only been in relation to commercial property, but we are starting to see them pop up in relation to residential property.
Yeah. So coming back to, and we did a recent episode around financial plans, coming back to what is the end outcome you're looking for, and this is where talking to somebody one-on-one where they can talk you through the risks and benefits of your own personal situation can be quite helpful. But maybe it's still doing nothing, understanding your money is going backwards with the idea that you'll be able to buy property in whatever period of time if you're regularly saving or something's going on.
Yep.
Maybe it's you're looking at investing into a share portfolio or a managed fund. Maybe there's the opportunity to, invest in yourself, start a business. And we'll do something completely separate around understanding the risks of doing something along those lines. But there are definitely options for you, but you just need to work through your situation, the pros and cons, and go, what's the right thing for me? Okay, we'll wrap it up there. Thank you very much for joining us. Please make sure to subscribe on YouTube, give us a review on Apple, and we'll see you next week.
Cheers.
Thank you.